Has it ever happened to you that you trade on demo and everything goes well, but when you trade on your live account, you start to lose? Another very common question that students ask me is, why is it that every time you trade and open a trade, either buy or sell, you start with a small loss? In this video, I explain how spread, commissions, and swap impact your trades and what you can do to optimize your profits. When you enter the world of trading, one of the first things you need to understand is how the costs associated with each trade work. It's not as simple as buying and selling an asset and collecting the profit. There are several types of costs that, if not considered, can significantly eat into your earnings. Below, we'll break down these key concepts: the spread, the trading commission, and the swap fee. Understanding how these costs work will help you make better decisions and optimize the management of your trading account. What is the spread? The spread is the difference between the buy price, ask, and the sell price, bid, of an asset. Every time you trade, especially in markets like Forex or with CFDs, you'll notice a small gap between these two prices. This difference is known as the spread, and it's one of the ways brokers make money. Spread example: imagine you're trading the euro to US dollar currency pair. The buy price, ask, is 1.1250 and the sell price, bid, is 1.1248. In this case, the spread would be 2 pips. This means that the moment you enter the trade, you're already starting with a small loss. For your trade to be profitable, the price needs to move in your favor enough to cover the spread and generate an additional profit. The spread can vary depending on the asset you're trading and market conditions. During periods of high volatility or low liquidity, spreads tend to widen, making trading more expensive. Conversely, in highly liquid and stable markets, spreads are usually tighter, which is more favorable for traders. Trading commissions. In addition to the spread, many brokers also charge a commission per trade. This commission is a fixed or variable fee that the broker applies each time you open or close a position. The commission is usually a very small percentage of the total value of the trade, though it can also be a fixed amount per lot traded. Example of trading commission. Let's say you're trading with a broker that charges a commission of 0.1% per trade. You decide to buy one lot of an asset valued at 10,000 euros. The commission you'd pay would be commission equals 10,000 euros times 0.1%, which equals 10 euros. If you later close that position, another commission of the same percentage would apply. So, in total, you'd pay 20 euros in commissions just for opening and closing the trade. However, to simplify things, brokers often charge both the opening and closing commissions at the time of purchase. For example, if you hit the buy button, you might see a combined commission of commission equals 10,000 euros times 0.2%, which equals 20 euros. The swap fee or rollover. The swap fee is another cost you need to consider if you keep your positions open overnight. Swap is a charge applied when you leave a trade open past the market close in your time zone. This fee is related to the interest rates of the currencies you are trading and is charged to reflect the cost or benefit of holding a position overnight. Positive and negative swaps. The swap rate can be either positive or negative, depending on the interest rates of the two currencies involved in the trade. When trading Forex pairs like euro to US dollar, each currency has its own interest rate set by its respective central bank. Positive swap. This occurs when the interest rate of the currency you are buying is higher than that of the currency you are selling. In this case, you'll receive a small payment for keeping the position open overnight. Negative swap. A negative swap occurs when the interest rate of the currency you are selling is higher than that of the currency you are buying. In this case, you'll be charged a fee for holding the position open. Swap example. Imagine you're trading the US dollar to Japanese yen pair and hit the buy button. In this case, you'd be buying US dollars and selling Japanese yen. Suppose the interest rate in the US is 2% and in Japan it's 0.1%. If you keep your position open overnight, you might receive a positive swap because you're buying the currency with the higher interest rate, USD. If you were selling US dollar to Japanese yen, you'd pay a negative swap because you'd be buying the currency with the lower interest rate, JPY. Triple swap. On Wednesday nights, Brokers charge a triple swap because the Forex market operates Monday through Friday, but transactions continue globally over the weekend, and currency values still fluctuate even though you can't take positions. Additionally, interest rates accrue over the weekend. To account for this, brokers apply a swap charge that covers Friday, Saturday, and Sunday at the close of the trading day on Wednesday. In other words, on Wednesday night, you'll be charged a triple swap to cover the cost of holding your position over the weekend, even though the market is closed on those days. What if you open a position on Wednesday and close it on Thursday? You'll still be charged a triple swap. I know, it doesn't seem fair, but that's how the system works, and it's something to keep in mind if you tend to hold positions open during the week. How these costs affect your balance. All these costs, spread, trading commissions, and swap fees, directly impact your balance and, ultimately, your profitability. It's crucial to factor them in when planning your trades, especially if you intend to keep positions open for several days or if you trade frequently. For instance, if you're trading a currency pair with a wide spread, your trade will already start at a greater disadvantage. Additionally, if the broker charges a commission for each trade and you decide to hold the position overnight, a negative swap could further erode your profits or increase your losses. If you found this class useful and feel like you're learning from this free trading course, imagine the level of knowledge you could achieve as a student in our premium trading course. If you've ever felt stuck in trading due to the fear of losing, lack a clear system and strategy resulting in inconsistent outcomes, or even if you have experience but struggle with emotional control, preventing you from being profitable, the solution is right in front of you. The only thing missing is investing in knowledge. Stop making excuses about not having time to learn or trade, because we all have 24 hours in a day, and if you manage your time well, you can carve out 20 minutes a day to learn. You'll find more info in the top right corner by scanning the QR code on the screen and through the link in the description. Click and let's connect inside the premium platform.